another episode of Beating Alpha. This is episode 162, and we have a very special guest on. His name is Mike Taravella. So a little bit about Mike and the things that he's currently working on. So he is an asset manager for Rand Partners and is responsible for overseeing over $100 million in assets currently under management. Mike collaborates with vertically integrated property management team to ensure the execution of the proper portfolio business plan. Mike is actively pursuing new opportunities with the market and developing relationships with investor bases. And again, Mike is a CPA, and before joining Rand Partners, he worked 5 years professionally in accounting. So experience ranges from working with Ernst & Young to working with Dan Gilbert's startup community at Rock Ventures. And again, for more information, make sure to get in contact with Mike himself. So that's going to be through email and the website called randpartners.com. And of course, all of that is going to be linked in the show notes. So Mike, again, just want to say a big thank you for coming over today.
Yeah, absolutely. Thank you so much for having me on, and excited to be on Talk Real Estate on this wonderful day. So just happy to be on.
Exactly. Beautiful, beautiful. So awesome. Again, that's a nice hat that you're wearing today. First of all, I have to give you that because it's all about that. Yeah.
The Jake and Gino swag. So
Exactly.
They always do a good job of swagging out, and so it's just happy to be on. And the new model.
Here we go. Yeah, and these
asset manager model.
Yeah, so and those are great people like Jake and Gino that a lot of people that I had on a podcast previous to yourself, they're getting mentored and educated again through the books or mentorships by Jake and Gino. So those people are helping a lot of people to start their own personal real estate businesses as well. So that's very awesome. And again, part of the Rand Partners journey and the story. So it's that, the Jake and Gino. But what about your personal story? Can you take us back to the point working as a CPA? How did you transition into multifamily and real estate business?
Yeah, it even started in college. So like in high school, that business. My high school teachers were like, we're doing accounting. So I went through college. I started like a screen printing company. And even I was about to graduate with my master's, and my professor said, I asked her, I'm like, am I going to like accounting? And she's like, no, you have you think differently. And I thought she was messing with me, and then went through it. And I didn't realize until like, grinding through the accounting piece. So Ernst & Young was a great resource to help me learn and understand the financials and how to test, especially during due diligence. It's important to understand the financials and how to test those numbers. But then that experience launched me into working with Dan Gilbert, the owner of Cleveland Cavaliers and the Quicken Loans. And I helped to launch a couple startups like 100 Thieves and media production companies, and just really teaching owners how to know their numbers. And working that closely with Dan helped me realize what he was doing with real estate. And so I bought a single family at the beginning of 2016, and then I got one in 2017. But I realized I was telling these startups to scale their business, but I wasn't adhering my advice to scaling my real estate business as well. So I, being loyal to bigger pockets, reaching out to people, connecting to people. And I realized that multifamily is the answer. John Kasman, with 2020, as a child, you're told never to talk to strangers on the internet or meet them in person, but went to his first live event in Chicago, and it just changed the game of just expanding my mindset. So from there, moved to Chicago to be closer to John and other investors and like-minded individuals. And then I was doing the 10 p.m. to 2 a.m. shift. So I'd work my day job and just work 10 p.m. to 2 a.m. I wouldn't advise it for everyone, but for me, I was that passionate about real estate, so it didn't really feel like work. So I worked through that, started my own podcast, and then I got a mentor of mine reached out to saw Jake and Gino were hiring, Jake Stenziano and Gino Barbaro, and we're looking for a team member on their team to kind of have that numbers background more as they expand their portfolio. And so a year and a half ago, I joined the team, moved down to Knoxville, Tennessee, and we've done 3 transactions and refinances, and we're just looking to continue to expand the portfolio on top of build processes. I mean, Q4, we're doing budgets, all the fun, sexy stuff that people don't talk about. when it comes to real estate. So it's been an exciting journey and looking to continue to expand our portfolio and our reach.
Got it. So coming back to the point, when have you started to work with them, with Rand Partners? How long ago?
About a year and a half, June of 2019, or yeah, 2019. It's about a year and a half.
Got it, June 2019. So even know the date. So that is awesome. So can you talk about, because again, your responsibility with Rand Partners currently is to oversee that $100 million, portfolio that they continue to grow. So can you talk about your personal kind of day-to-day basis, processes and operations and what you're kind of, doing with the company?
Yeah, for sure. So we start every morning with a huddle with our proper area managers. So we just want to see what's going on the properties, because if there's, as an asset manager, you're accountable. That's like the, one word I want everyone to think. Everyone thinks the asset managers, you're the manager of the manager, but really it's a team collaboration, right? So the property managers are handling the day to day, and I'm overseeing the numbers and looking for new opportunities. So it's important to realize that it's keeping everyone accountable, right? So anything that kind of happens, I make sure I can be a resource and course correct. But we start the morning with huddles. I kind of check my email, see if any new opportunities. I'm calling brokers, talking to our investors. Towards this time of year, like I said, we're working on budgets for every property to make sure that we're going in the right direction. Are we getting our income to increase, whether it be through rental income? Are we increasing our other income like pet fees, RUBS, application fees, and etc.? And then also too, expenses go up, right? Just because of inflation and everything, but can we control all of our expenses? So it's just important to realize, are we going in the right direction and are we hitting numbers every month? And if not, just figuring out, working backwards, how can we improve? How can we hit that number and what's going on at the property? So it's a lot of collaboration with the property managers, and that's why it's not I don't like the managers. The asset manager manages the managers. It's just a team effort because something could be happening at the property that I need to be aware of that the numbers don't say, and it can affect. So it's a really collaborative piece with our vertically integrated team that we have. So it's just finding deals, talking to our property management team, and just reviewing the numbers to make sure we're hitting our marks going forward.
Yeah, so kind of important part after after the acquisitions part, is how do you manage and continue to maintain these properties and acquire, increase the value of the properties going further. So it's kind of, you're playing an important role. What I'm trying to say, but and of course we can talk about those property management pieces of your kind of day-to-day process. But coming back to the point of just saying, acquisitions parts, and you kind of said you're actively still looking for deals again with some of the other partners, probably acquire. And again, you're looking for deals in Tennessee and Kentucky at this moment, right?
Correct. And we're looking to, so we have about 900 units in Knoxville. We have the rest of them are in Kentucky, but we're looking for Huntsville, Alabama, Greenville, South Carolina, and we're just really aggressively looking to expand, but we're also kind of our three pillars: buy right, finance right, and manage right. So it's easy to get the financing with our background and our pedigree, but the buy right, valuations have skyrocketed since the pandemic. And manage right, we got the dream team of property managers on our side to help us. So, it's hard checking all three of those boxes now, but we're still actively looking. We're doing off-market campaigns, talking to brokers. I think I've reached out to 60 owners already in the middle, and we're mid-November, so 60 owners this quarter, 60 brokers this quarter. So we're just continuing trying to find the next deal, but we're not going to make feel like we have to do a deal. We're only going to do deals that make sense for us.
Got it. Okay, so can we talk about kind of decision-making process behind picking and investing in those deals? So as far as I do understand, the headquarters of Rand Partners are in Tennessee, right?
Correct. Yep.
Yeah. So that's kind of no-brainer, investing in your own market that you're located in. But can we talk about, again, still about Tennessee and Kentucky, and how does those two markets compare to the surrounding markets, and what makes those markets better maybe for you?
Yeah, absolutely. So for us, Jake picked this market just the affordability piece, and he felt an opportunity to grow. We're always looking for population growth. We're looking for diverse job sectors. I'm originally from Detroit, so if you look at 0809 and it being heavily automotive, the 0809 crash was severe. So we're looking for diverse job sectors that no one sector contains more than 25%. We're looking in more landlord-friendly areas because it's imperative to us that we can operate. Because if you look at New York right now and California right now, it's the wild west of what can and can't happen. But we're looking for growth as a market, and then that sub market, we're really diving in to see what the household median income is. We're not looking at any properties that have a median income of 45,000 or less because it's hard to raise rents, it's management intensive, and we're just really diving in. And we want to see where it is. Like our property in Lexington, it's near all three different malls. It's the place to be. We're either looking where the place to be is in that submarket or path of progress. So to make sure like this is the next spot to be in. So those are kind of those aspects when looking at the market. When we're looking to on acquisitions, the next thing is the property. We're looking at we'll look at 1970s, but really focusing on 1980s and newer, just because we cut our teeth on a lot of older properties and they're leaky and they're old and there's a lot more maintenance and headaches on them. So we're looking for that newer property that we can still add value with our team. And then lastly, financials. Can we increase rents? Can we increase other income? And can we decrease expenses? There's our last property, our last syndicated deal, we saved 30 grand by not renewing a billboard for rent. So it's just making sure you can add value to that community as much as possible. So that's kind of all the boxes we have to look for when we're looking at acquisitions.
Got it. So coming back to the market, maybe Tennessee and Kentucky both, and you can kind of cover, because again, what's currently happened with the pandemic and, a lot of people kind of working from home and, businesses 1920, established 1920, they're closed kind of almost overnight. So there's a lot of changes that are happening now in economy. But in those two states, what are the main kind of job drivers and the biggest companies that are there?
Yeah, in East Tennessee, it's just been, we have the University of Tennessee, a lot of like Bush's Baked Beans. We have a lot of different, it's very diverse sectors here. We have the population growth in Lexington. We really love that the government has been doing a lot of grants. So even through the over a year that we've purchased our asset there, they've been investing in entrepreneurs. They have a lot of white collar jobs. Louisville's been a big city, and the biggest thing there has been just the size and just people. It's continuing to grow. It's more blue collar, but they've done a good job of having a lot of rental assistance programs, especially during the pandemic. We've had our residents use. So those are, all have large employers, diverse sectors. Louisville all have a major university. So Lexington is the University of Kentucky, Louisville, University of Louisville. So it's just educated groups, a lot of different jobs, diverse jobs, and just making sure in those submarkets we're buying in the right areas. I think one of our properties in Louisville, they just announced that they're building less than 5 minutes away from our property, a commercial complex that'll have a lot more jobs coming to that area. So like I said, following that path of progress has been huge. So always having your Google alerts on for those cities and those submarkets to see what jobs are coming in and whatnot. So it's, a lot of different jobs in those areas.
Got it. So coming back to the part of buying rights, can you talk about, again, the minimum and the maximum unit count that you're looking to acquire at this current moment?
Yeah. So if it's in Knoxville, we have a lot more flexibility because we have the economies of scale. So if it's a 20 unit, but it's next to our property, it's fine. But if we're cracking a new market, we're generally looking for 100 plus units. And the reason for that is so that we can have enough scale in that area to have on-site management there. We looked at some properties that were smaller, but the rents were so much higher that we could afford property management. So we're looking for 100 plus units in that area. We're generally looking 1980s and newer. Like I said, just because in those new markets, we have a construction crew here in Knoxville, so they can work at several different properties and handle it. But if we're in a new market, we don't have that scale yet. So we have to kind of be very strategic in our first acquisition. And then from there, it's just making sure, you know, are the roofs good? Are the good bones, right? Because the last thing you want to do is buy a property, it's lopsided, you have to do foundation work, it gets very expensive. And us being fiduciaries to our investors, the last thing we want to do is go into a deal thinking we can cash flow and then, you know, the building's falling apart. So that's why we're focusing on 80s, but sometimes newer products could be not as built as well. So it's important to make sure you have strong bones for those properties.
Got it. Okay. So maybe you can give us advice again, because there's a lot of people right now, and I think there's more than a few who are going to be watching or listening to this episode right now. And, you know, they're having this kind of problem with sourcing deals. And again, you kind of mentioned that you got in contact or sent over kind of, you know, messages or like with 60 brokers, 60, you know, property owners. So can you talk about how do you go about personally, you know, and making those kind of deals coming to you, or you know, it's through the relationships, through the brokers, so maybe using some sort of a creative strategies that help you kind of with the deal sourcing part?
Absolutely. So I think before you even call a broker, make sure you're clear on what you want. I think, I mean, we don't try to put ourselves in such a hole that we can't see deals, but when you're first starting off, you kind of look at everything. So if the more crystallized criteria you have, it can showcase to a broker the first time that you're serious, right? Because there's a lot of, I talked to a lot of brokers and they're like, yeah, I'm getting a lot of calls, but no follow up. So just make sure you have your criteria of what you're looking for. It doesn't have to be perfect, but I'm looking for this year and newer. I'm looking for 20 to 40 units. You don't have to be, you know, just because you're listening to the podcast, you don't have to say, oh, I have to follow Mike's criteria. Develop your own. This is your journey in investing. So you could do a 20 or 40 unit, and that's okay. So build your criteria, find all the brokers. I check LoopNet. CCIM has a list in that city for brokers, and I just contact them every 3 weeks. They might not answer the first call, but the more you see your number and build that rapport, the better it's going to be. And just kind of take notes on them and just make sure you always follow up. I have a project management tool called Asana. It's free. And so every 3 weeks, once I call them, it'll remind me to call them in 3 more weeks. And just I follow it religiously because I know when I'm talking to them, a deal is going to come to them. And I might, and you know, you're doing a good job because they'll send it to you before they put it on the market. And it takes time. It's anything in real estate, you know, it's a very long game we're playing. So don't expect the first call they're going to get an off market deal. Just introduce yourself, show you're credible, show you have a team of investors that you can tackle the deal, because brokers want to know people can close. And so you could be starting off and just be upfront of, I'm just learning the market, but I know it's a lot of different advice if you're new, but just principles, develop the relationships, because that's going to get you further. Don't think of it just as a transaction, and good things will happen to you. And it takes a lot of time, patience, and you know, hard work pays off. So just keep following through.
Exactly. So real estate is definitely not a get rich quick scheme. It's like, but it's definitely get rich for sure. But as you said, it does require some patience. Well, probably a lot of it patience, and a lot of it is a teamwork and having the right people, you know, people and partners on board in a company. And again, you, as you mentioned, you have those partners when it comes to property management side and the construction side, because you have vertically integrated those and with brand partners, and you having that company in place, which is good, and we can talk about that. But coming back to kind of deal sourcing parts, again, would you recommend for people who are listening, or maybe you actively right now, are you looking for deals where you can actually redevelop, you know, let's take, you know, office space, which a lot of that is probably vacant, because, you know, there's a few multifamily investors that I came across with the redeveloping office space, or, you know, hotels, because a lot of those are vacant and they're just sitting empty. So are you looking to do that type of strategy as well?
We've looked into it. We're actually looking and potentially developing in 2021. We just seen valuations. I think CoStar just announced that in Knoxville there's a property that had sold for 190K a door. Uh, Definitely surpassed our expectations. But when prices are that high, we reflected in the last quarterly planning meeting of what do we need to do to develop. We kind of have a construction crew but now how do we take the next step so that we can develop clean assets that are easy to manage, cash flow from, I would say day one, but it's development, but cash flow once it's operating. Because we have the team, we want to lay roots, and so as us as an organization, it makes sense to developing. I think those, I think as your team, in these tougher moments when deals are harder to come by, you have to, reflect and see how you can pivot your business plan, because stuff that worked a couple years ago or even a year ago won't work today. You constantly have to reflect and see, not change the whole, but get creative with it, right? I think, you as your group, and if you're just starting off, you just got to keep on deals to make sure that you can, when a good deal is. And then that way you're just still networking, building your system so that once you get a deal, you can operate and run with it.
Okay, got it. So now kind of moving on to the property management part, and you have that as you said, vertically integrated. So the management and the construction part is there. So what would you recommend for people who maybe already have, let's say, 50 units or 100 units, and maybe from your personal experience, when is a good time to create a vertically integrated kind of property management on site?
Yeah. So the property management team, I'd say if you have a couple properties that are next to each other, I would wait till you have a little bit of scale, because it's a lot of work, because you have to reflect to what is your highest and best use of time. So on the property management team, you're building an entire company that's just to manage, right? It's not necessarily generating a ton of revenue because you're not generating assets, right? So it's a pain point. I think Jake and Gino had a couple hundred units before they started hiring and doing it themselves. But I think if you're thinking about it and you have the scale and you have the time, because it takes a lot of time, right? You're going to be answering those calls if a maintenance person isn't there or something doesn't get fixed. You're answering the calls. So it really just depends on what your highest and best use of time. And so just making sure that you can execute it very well, because if your customer service dips, then residents won't renew, people won't live there, your reputation, and then you're not acquiring deals because you're managing. So it's a catch 22, but think of it as if you have over 100 units, I would start thinking about it and maybe hiring one person to help. But it's case by case. But if you have some scale in your market, you you know want to do it because it takes a special person to do it. Jake Stenziano is built an amazing team with an amazing culture, and Gino Barbaros as well. But it property management isn't easy. That's why they have the best stories of, we found a baby alligator in a unit. So it just, either find a partner or figure out what you like to do and really just see if do you want to find deals, do you want to manage the deal, and just kind of cover your weaknesses.
Yeah, awesome. Baby alligator. Here you go. I mean, those that's a reality of life and property management, right? Those things do happen.
You always have the best stories, so that's why you always ask them. It's kind of like the Uber driver. What's the craziest thing that's happened?
That's it. So listen, so can you talk about, because again, during these times, it's like still COVID. So the date is 11th of November right now. So and still the COVID is here. And how do you actually go about, because we have, on-site property management company, and there's, a lot of multifamily investors and operators that I'm talking with. And some of those people, they're saying kind of, there's this big kind of issue right now when it comes to collecting rents. So maybe you can talk about how you go about to make sure that that kind of process is as smooth as possible, and you can collect as, higher percentage of the rents as possible as well.
Yeah, great. So I think it's also geographic location wise as well. So us being in the Southeast, we've had very strong collections. We've been averaging 94 to 96% of rents collected month over month during the pandemic. Also, too, we were very proactive. So we were sending a communication every other day on average at the beginning of, here's what's happening. Here's, the new laws and rules around it, the CDC moratorium. Like, we were just, anytime there was news, we were a resource for our residents, because we realized that, we want to provide such a high customer service that we're helping them. And I think too, everyone's stuck at home. If you watch the news for more than an hour, you're like, I can't, the world is ending. So we wanted to be a rock for our residents to make sure that they felt safe, secure, We want to keep the integrity of the community. And we gave them a ton of resources, whether if it was 411.org, the rental place, and like whatever they needed, we provided and helped them out a lot. And I think that's how we had stronger rent collections. Also, too, it was just making sure that we could be that resident. We even communication wise, we gave everyone a roll of toilet paper because everyone was just buying mass loads of toilet paper, so there were shortages. But on the commercial side, we had access, so we packaged up a roll of toilet paper and note and says, during these crappy times, Ram Property Management is here for you. So
Love it.
we just tried to be creative and double down on the customer service aspect and just making sure that we helped get people on payment plans or rental assistance, like whatever they needed. Even if they just needed to vent to us, we were there for them during these times.
That is awesome, and that's a great way to go about, again, as you're saying, just hammering down again on a customer relationships type of parts. Which, yeah, again, it's a tough time for these people. So if you just try to understand these people and try to work out the payment plans, in some way, if that's possible with those people, that's great. And people will definitely pay, if there's a service, there again from your perspective, which there's
Yeah,
definitely is.
they want to make sure you're getting taken care of and not just a number on the rental,
Yeah.
right? So by us communicating a lot, you could quickly identify what's happening. And we called it just a narrative of each resident of, did they pay? Did they not pay? It's not, oh, let's get them out. It's, hey, let's follow up with them, seeing if they're okay. Because we don't know, especially what's going on. So we just wanted to make sure we're very over communicative of everything going on so we can help them.
Okay, so kind of taking a little bit, like 10,000 view on the current investment world, because there is again different asset classes, different investment classes as well. Talking with the stock market, which it's you personally, the story behind the stock market. So again, a lot of people kind of not choosing maybe to pursue that, but maybe they're still doing that. And again, real estate assets, mobile home parks, development, which are actually you're looking to do in the future. So, just senior housing, which is very popular, get very popular as well. And as there's 10,000, seniors becoming every day. So there's a new trend that's there as well. So how is multifamily, and particularly how does that compare to the other investment vehicles out there, and why is it better than the rest of the things out there?
So I think it's just following the debt, right? So I think a lot of lenders are weary on student housing. Like I talked to lenders in January before this even happened, and they were weary of student housing. And then COVID happened, right? I know a lot of lenders aren't too fond of senior housing, only because it's kind of the Wild West, right? So I think it's just following the debt. Multifamily continues to be a strong asset class because Gino Barbara said people need food, clothing, and apartments. We're becoming a renter nation. I think like the retail is taking a hit and office is taking in a hit, but overall, I think they'll eventually bounce back. But people need a place to live. I think affordable housing is, we focus on BC apartments. And so affordable housing is going to be an issue or is an issue. And so we just want to make sure we're providing such high customer service when it comes to that people recognize and want to live in the Ram properties. So when it comes to other spaces, people need a place to live. I think valuations will continue to rise. There's going to be some sort of dip event, I think, but I just think overall, I believe in multifamily because people need a place to live. You have the scale and affordable, apartments aren't going to go away. Even if people go full remote learning, they have to live somewhere. So I think it's just, it's a strong asset class. Continue as long as it cash flows and appreciates in your good markets. I think you'll be taken care of. Versus the others, debt freezes up, and it's a tough market to play in sometimes. So it's just that's why I believe it's the best asset class relative to the others.
Okay, so and coming back to the location part, because I spoke with some people as well that say they bought the property, and like 100 meters from that property, there's kind of so they're kind of C area, which is saying you're acquiring B and C type of classes, and then I do understand why it's not A and B and D. But let's say if there's 100 meters, further from you, it's kind of the ghetto is starting there. So how do you pick those niches? Because like from my perspective, I'm just trying to understand, because what's happening right now again with the jobs, there is all of it is changing, where again that company, because before when you used to buy an apartment building, let's say you're buying it because there's a school or university and people used to go there, people don't go there anymore, maybe doing remote stuff. There used to be a business, that business is closing. So how do you make those kind of investment decisions from a location standpoint to make sure that it's kind of in a so-called good area?
Yeah. So we drive all of our, the properties. So we're still going at, driving through our cities, checking out our properties, checking out new properties. So we're driving the areas and we feel comfortable because you can look at a map and think it's great. We also call the police department to see, hey, is there any issues in that location or at that particular property? Because we want to get as many opinions. We even too like can call local businesses, and I've had people go, as long as you're, graduated high school, you can get a job here. So we're just constantly networking with locals in that market, whether it's driving, whether it's calling local businesses. I don't think there's necessarily a mass exodus when it comes to, businesses, but it's just really making sure you're driving, getting a lot of feedback, because I consider feedback like a wave. The more you check in on it, you're going to get a lot more feedback. But if you don't go check it out for a while, you might get a wave of negativity and just, whoa, I didn't expect it to be like this. So just constantly checking up on it. Google Alerts is now, those are great resources to kind of keep tabs. But in the end, I think people call up a business and see where people live and see what happens. And that's the best way if you can't leave your home. But police departments are always there. They see it every day and will let you know very honestly what's going on.
Mhm. Okay, and coming back to the property management is, I'm sure maybe those kind of, because again, you have 100,666 units currently in the management. So I hope that number is going to change soon for some people because they just maybe
Yeah.
prejudiced. But again,
Yeah,
talking.
we're trying to get one more unit built, so we're working on it.
It's coming up. It's coming up. Here you go. So listen. So talking about kind of those eviction processes, which look, this is real life. Things do happen. But when it comes to the tenant
Yeah.
screening process, like can you talk about what type of systems do you have in place to make sure that that potential tenant is going to be the right one for your property?
Yeah, so we have them fill out a rental application, which costs money. So it's kind of you're providing a lot of different gateways to make sure they check all the boxes. So they're providing employers. We do a screening, which always I always hear horror stories of people not screening residents. Always screen residents. They have to make 3 times as much as their rent on a monthly basis. So it's making sure their job, their salary, no prior evictions. Those are kind of the big things that I see. We reference check with previous landlords to see how they any issues that we need to be aware of. So just making sure you build that criteria on the front end, because of fair housing, you want to make sure it's documented. But yeah, three times they make 3 times as rent and no prior evictions are the two biggest pieces that we see to make sure they qualify.
Okay. And coming back to the rent partners, I mean, we talked to, as we spoke about the number of current AUM, like what are you planning to accomplish this year? Do you have I'm sure you have quite big of a deal flow, again, as mentioned, through the broker relationships and through other kind of personal relationships with the, operators and probably mom and pop top operators out there. So how many deals or how many numbers of units you're planning to close on before the end of the year?
So we've closed on about 100 units this year. We're hoping to get another, hopefully 100 units under contract. It takes 60 days to close, so we're kind of wrapping up on the year. But our focus every quarter is to get one deal under contract. Us as an organization, whether the size, right? Because we don't want to do a bad deal, but we're trying to make sure we're doing good deals. So we've closed on 100. Hopefully, we'll have 100 under contract by the end of the year. But just get one deal under contract per quarter. So I think we've hit 2. This will be the second quarter if we get them. But I'd rather to the listeners, don't feel like you need to chase a unit number. Just do one deal a quarter, and you'll do really well. Because it's tough, right? And it's not, even as a new operator, you're gonna have to partner. Our lenders have been calling us nonstop, just making sure I's dotted, T's crossed. So it's hard, but just we're measuring 120 brokers we have to call by the end of the year. I think 200 owners by the end of the quarter. So just making sure we're measuring the lead measure, not the lag measure of number of units. So hopefully another 100 units under contract by the end of the year. Fingers crossed.
Here you go. Here you go. Fingers crossed. Definitely. I'm sure it will happen for you guys. So, because you're doing a phenomenal job again with that. But coming back to the point of, because you're looking to acquire these multifamily apartments, and I'm sure the strategy that you're using is syndication, kind of the model to do those deals, right?
Yep. Yeah, we do. Sometimes we syndicate. Sometimes we do an internal deal with a joint venture, because to our investors, the deal might be really small. Like a perfect example is we did the 48 unit here, and we had to pay cash. So to kind of coordinate some investors to coordinate a cash closing is really hard. And we knew the property wasn't going to cash flow from day one. It was half occupied. The previous operators ran out of money. So we knew it would take a minute to get the apartment up. We've already repaved the road, the parking lot, 2 new roofs, turned about 11 units. So we're still trying to get them leased out to cash flow, but we don't want our investors in knowing that, it's eventually going to cash flow. We want to make sure it cash flows day one for them. So syndication is just a tool in the toolbox that we use.
Got it. So using that tool in the future, let's say if it's not for the small deals that you're going to do a JV with some of the partners that you have, what about the syndication? Let's say for the people who are listening or watching this episode, they never heard about what syndication is. Can you give a kind of 10,000 feet overview what it is and how people can invest with those in those type of deals?
1,000%. So what happens is I, as an operator, will go find deals, and I will also be networking with investors. So when I have a deal, I can present to the investors. If you invest in a deal, you'd be a limited partner, which means you are completely passive. You don't have to deal with the property managers, the landlords, residents, contractors. You just sit in your home, let your money do the work. So you'll get paid cash flows through cash flows or distribution, and you'll also get tax benefits. So with depreciation, cost segregation studies, we front load that depreciation so that you can show paper losses while earning cash flow. So it's important and us as operators, we do 3 monthly webinars the first 3 months because those are usually the best stories. And then we do quarterly webinars after that. We also provide monthly statements. So we're just constantly getting a lot of feedback for investors, so they're in the know, because we want to make sure our LPs earn as they learn, because we want to make sure a lot of our LPs have done their own deals after investing with us. So, and we take pride in just making sure we're showcasing all the good, bad, and ugly that could happen in investing. So it's been a fun process, and eventually when you do so many webinars, sometimes it's literally, hey guys, we had a water bill this month, we didn't have a water bill next month. So it's been cool, and you develop a lot of relationships, and like I said, it's that feedback of going back and forth with your investors to make sure that it's still the property's operating smoothly.
Got it. Yeah. So, and that's kind of the part that you're running with the run partners. I mean, it's a very important part, definitely. So that's awesome. Again, and running that part of the run partners and actively looking for deals, building relationships, going on podcasts just like this one that I really appreciate you coming on today and sharing all these tips and strategies and why and how people should invest in multifamily deals now and going further, because it's a kind of crazy year. So thanks for giving some clarity and tips on that. But what is your personal legacy that you're looking to leave behind you besides working with brand partners as well?
My personal legacy is just my goal is to help 1 million people become investors. So whether you can do a syndication, or because I think a lot of people is that financial piece they get weary about and they think they're safe with a job. But I think whether you're, in your place right now and you have an extra garage space, that to me is teaching people to be an investor, or Airbnb being a unit. So I just want to make sure I help 1 million people become investors. How big or small is up to them, but that's my legacy, is just help, because my family's all teachers, and I want to help teach people become financially free or financially improve their lives as much as I can. because, you work a lot with your job, but if you can have that investor mindset, it'll set you up so much happier for success in life. So my legacy is to help 1 million people become investors.
And that's a very great legacy to have. I mean, it's I'm sure you're somewhere there in the beginning, or maybe you're halfway there. I don't know, but maybe with this episode we can help you to get more people educated. And on that note, you should get in contact with Mike. And again, probably one of the best ways will be maybe through email or social media. So the email is miket@randcre.com, and of course that email is going to be down below. For more information about Rand Partners, about what they're actually working on, to see existing deals, go to randpartners.com. And don't forget to share this episode with a friend of yours who loves real estate but never pulled the trigger maybe before and wants to get that education part and maybe find out the reasons how to invest in real estate actively, passively, so make sure to pass this episode along. And Mike, again, thank you very much for coming over today and sharing all this wisdom. I really appreciate it.
No, thank you for having me. And share this with a friend who doesn't love real estate, because they need to know
Here you go.
all about real estate so that they can be a better investor. So share it with people who don't even want to invest in real estate. That's how much they need to know about this podcast.
Exactly. Love it. Love it. So again, thank you, Mike, for coming over. Make sure to share this episode. And as always, I'll see you next time. Thanks for watching.